So, yeah, this time he really is here. Jorge Milla, who is going to talk about the legal provisions to prevent undervaluation, and he will be followed by Santiago Ibáñez in a few moments.
Thank you. Well, good morning. Guten Morgen. Okay, guten Morgen. Thank you very much, Walter. Yeah, after the Germans and the breakfast, we're finally here. Well, we're going to talk about the legal provisions to prevent undervaluation. Okay, and main topic is going to be the possibility of rejecting the transaction value in case of detecting undervaluation. These are the main provisions that we have to prevent this undervaluation. We got the custom valuation code. We got the Article 140, and the ministerial decision on, I'm going to read it, on cases where customs administrations have reasons to doubt the truth of or accuracy of the declared value. And finally, the advisory opinions. Okay, this is going to be what we're going to follow to detect or to talk about this main topic. This is going to be what we're going to follow. It's going to be the provisions firstly, then we're going to try to understand the problem, make a review of some cases, 3 cases, and we're going to give our final remarks. Provisions, as I said before, we got the custom valuation code. We came more or less the same from the Tokyo round to the round of Uruguay. Okay, we got a focus on Article 1, as this is going to be in the website, so I don't think that we're going to have, and obviously most of you know about that. I don't think we have to read it. I just wanted to keep it in the slides so you can read it carefully when you got the presentations in the website. Okay, we got Article 1 and Article 17. Then we got the Article 140, the Uruguay round ministerial decision. Okay, we're gonna it's quite a long one, but we're gonna focus on the 5 main steps as soon as we start with the reviews. And finally, the advisory opinions, where the committee considers that the question, okay, about the price doesn't have to be the only one fact that is going to cause to reject the proposals of the Article 1, which means that only buy a lower price doesn't have to mean that there's a fraud. Okay. Understanding the problem. Well, where the problem comes from? It comes from the discussion between a couple of blocks. We got the developing country. This is in the round of Uruguay. We got developing countries, which is where, as far as I know, it was led by Brazil and India. They thought that they couldn't fight against false invoices that they were issued. And Argentina came out with asking if there could be a possible solution or there could be an effective tool against these behaviors. Okay? From the other side, the US and the European Union, they didn't think that it was a good idea to move any or touch any of the principles of this customs valuation code. And obviously, moreover, they didn't want to, or they wanted to avoid introducing any alien or foreign elements in this code. Okay. So finally, they came out with this ministerial decision, and this is a summary or the 5 main steps that the ministerial decision sets in order to prevent the fraud or by using an alternative valuation method. So you don't want to use the transaction method, transaction value. You can use this method, but you have to follow these steps. Okay, main one is the customs administration must have reasons to doubt of the truth of these documents. Second thing that the customs administration has to do is they have to ask the importer to provide more information. Also, they should say which one is the one that they needed. Then, if they still have a reasonable doubt, well, they, in this case, they obviously will have to use any other method apart from the Article 1. Before taking a decision, they have to, again, communicate the importer, okay, saying that they are doubting of the accuracy and everything. And finally, when they make this decision, they have to communicate the importer in writing this decision and the grounds thereof. Okay, those are the main steps, the 5 main steps that they have to follow according to the ministerial decision. They don't wanna, or they don't believe in the value that's been declared. Now we're gonna see 3 different cases that came with obviously with a different solution. Case number 9.1. This is a company which is established in a country of export X and is exporting motor vehicles to another company. And this company is selling them to dealers in that country. Okay, there were a couple of invoices and there was a big difference between both of them. When the invoice issued by AutoX to the company which sells to the dealers, there's a value in current units of 180,000, and then there was another invoice from INC or incorporation to PCO amounting this 30,000 currency units. Okay, well, they obviously there was a difference between those 2 values, and the custom values they sum that. Okay, so they check that Inc. was an independent legal entity. The ownership of the goods is transferred to INC, who bears the risk of this free on board phase, and INC or incorporation bears the risk of non-payment by PCO. So the difference, they don't see any problem in this difference of value, and also they are independent entities. So main conclusion is that the sale between AutoX and Inc. forms the basis for determining the customs value according to Article 1. Okay, so no reason to doubt about that one. In case of case 12.1, we got importer A in country B buys high quality components from importer X in country T. Okay, in this case, there's a big discount. Okay, if you go down to, so as this is going to be in the website, don't need to worry about reading it now. I'm going to give you more or less the main facts. So the big problem is in the last 2 lines. Okay, due to the global economic circumstances, the exporter has to sell the stocks at a ratio of 30% below their cost of production. Okay, and also he wants to get introduced in the new market, so they got to make a very big discount. If customs authorities checks the values of other transactions, they will realize that they are selling at a very low price, so they could think that it could be any fraud. As they find that this is, they agree with that the importer is forced to make this discount, and also it wants to be introduced in the new country, they don't see any problem. And finally, the conclusion is that based on the information provided, the customs value will be calculated on the basis, again, of the transaction value using the price that the importer A pays to importer X, the exporter X. So, no problem. The first case, we saw that there was a difference between one invoice and the other. In this case, we see a very low price in selling. Next one, obviously, one had to be any problem. In this case, this company, the ICO company from country I, imported 2,000 units of consumer goods from country of export X, and ICO presented the following information in the declaration of import. Okay, they say that the seller is that company, is in domicile in that country. The manufacturer is MCO company, domicile in another country, and they done everything. Well, they paid in cash, and they don't have so much information, so much documents. Okay. Well, the custom authorities, the custom administration, analyzes all the imports, all the identical goods, and finds out there's a big difference between the values of identical goods. In this case, we got a price of 9.30 currency units per unit price, and if we go to the transaction value of the identical goods, it comes from 69.09 to 85, so a very big difference between those. Well, we have said that the price is not the only thing that has to make you think on a fraud, but well, in this case, it seems like there's a big difference. When they, what do? Well, they notify, they ask for some more data, some more documents, and they even say, what is the right thing to do is they not only notify the importer to give additional documents, they also say which ones, for example, would be interesting. Business correspondence or any other document confirming that the invoice, apart from obviously the accounting and everything. Well, they don't give so much information, okay? So let me give a big summary of what it says in there. They basically they say they did everything okay, and they don't give any more information apart from saying that the sale had been made by telephone. This is something usual in this case, as the custom authorities have checked before, so no problem about that. What they do is the authorities, they go to the audit the company. Obviously, the accounting was not updated, as a way of saying it. And they check that they have sold the goods for a price of 281 currency units. Well, they don't find they don't find those records, the accounting records updated, and they didn't provide any explanation apart from that one. But the main point is in here, in this one, okay? The audit revealed that an employee made a credit card payment to a third person during a business trip to the country. And those payments were recorded in the accounting record as administrative charges. I don't know how they do it everywhere, but this is the way they did here, administrative charges. Okay, so this is a big problem. What was the decision of the technical committee? Well, in these circumstances, they decide that we must conclude that you couldn't use Article 1. In this case, the custom value has to be determined in accordance with the provisions of Article 2. Okay? This case obviously had some information that we should take into account. Our final remarks regarding this regulation. Well, we must say that the valuation code makes it clear that transaction value is the preferred method of determining value. Okay? When it cannot be determined with accordance to the article, we can use to Article 1. We can use any other methods, and in the event of fraud, the administration must initiate an investigation to verify the veracity of what was declared by the importers. Following all those 5 steps, and being in an active position, not in a passive position, which is, okay, give me more documents. No, I mean, you better say which one you need, which ones would be better in order to prove that the transaction value is the real value, okay? Or the actual value, sorry. And we must expect, finally, that the courts be guardians of this application of the code that was firstly agreed in the round of Tokyo and finally in the round of Uruguay. And that's all for me. If there are any questions. Any questions? Okay. Okay, I think Santiago, the floor is yours.
Okay. This one is open. Santiago.
Thank you. Okay, good morning. I'm going to build upon what Jorge has said from the perspective of a couple of cases at the WTO that dealt with also with other topics, but also with issues regarding undervaluation. The two cases, the two disputes that I think are relevant for our discussion are the Colombia indicative prices and restrictions on ports of entry. Unfortunately, the brief name, the abbreviated name is Colombia ports of entry. So they omit indicative prices, which is the relevant issue for valuation. And the other difference is Thailand, customs and fiscal measures on cigarettes from the Philippines. Okay, beginning with Colombia ports of entry. In this case, Colombia had very good reasons to do something because they had, you know, Colombia is a country with very specific problems, and they had a huge problem with money laundering. And in order to launder money, they were they wanted to launder money and make money while you launder money. You don't want to pay taxes, and on top of that, when you launder your money, you want to make extra money. And to do so, they discovered that they could do that by underreporting value, by smuggling, and so on. And they discovered that the most typical route would be from Panama. You know that Panama is a country that offers secrecy and so on, so it makes a lot of sense. And so Colombia had a genuine problem with customs valuation. What did they do? They enacted some regulations providing that imports of textiles from chapters 50 to 64 of the HS, imports of textiles coming from Panama and also from the free zone of Colón in Panama would be subject to indicative prices, meaning indicative prices are database prices. I mean that the customs would calculate based on average by category of products, not by a specific product, by categories of products. So they were quite approximate. And these indicative prices would be mandatory if the price declared was below. If your price is above, no problem. But if your price fell below the indicative price, then the importer, the declarant, had to correct, they call it correct, an euphemism. They had to correct their customs declaration to comply with the indicative price. So the indicative price was a minimum, it was a floor for value. And in case the declarant did not want to accept this indicative price, they had two choices. They could reship the goods, so the goods will not be allowed in Colombia, or your goods are legally abandoned. The goods are not yours. So you accept the indicative price, or you go, or your goods are no longer yours. So you have to accept the indicative prices. They were quite tough. Okay, so the choice is to correct your declaration, of course, out of your own will. You choose to correct your declaration, and if you correct the declaration, you pay. You pay, and this word "you pay" we are going to see is very relevant. You pay custom duties according to the indicative price, and once you have paid, the goods are released. And okay, you can enter your goods in the trade of Colombia. Okay, after you pay and after the release of the goods, the documents of the entry are sent to an audit tax force of Colombia, and the audit task force will take time to review the import and to come with a final value. The audit unit will review the value and will come up with a final value. Okay, Panama didn't like this arrangement because Panama felt this was against the customs valuation code, because you are departing from transaction value, you are not respecting the hierarchical order of valuation methods. So Panama took Colombia to the WTO, and the defense that Colombia came up with was quite smart, because it was obvious that the indicative prices were incompatible with the WTO agreement on customs valuation. So the strategy Colombia came up with was, no, Panama did not understand. Indicative prices are not customs valuation. Indicative prices, we are only using them to determine the amount of a warranty. So what you pay, okay, it's not actually pay. What you deposit at entry, which is not actually a payment, is only a warranty, and we will carry out an audit of the value, and only after the audit of the value we come up with the proper customs value. So at entry, we don't set a customs value. We only set an amount of warranty. And the amount of the customs value will come later after the proper audit, case by case. This was very smart. The problem was that apparently they came up with this idea when Panama took them to the WTO, because, because the Colombian legislation gave a lot of evidence that this was not true. For example, the legislation called this payment, not guarantee. For example, in Colombia, even if Colombia is a member of the Andean Pact, and in the Andean legislation there is a cash deposit guarantee, but Colombia never incorporated into Colombian legislation the possibility to make a guarantee in the form, in the type of a cash deposit. So in Colombia, cash deposit did not exist as a type of guarantee. Also, they found that this audit that theoretically was the one that would decide the customs value, these audits were not taking place every time. In fact, it was very seldom that there would be an actual audit, and very seldom that there would be an actual determination of the proper customs value. Not only that, but in the cases that they found there was an audit, it was only because the importer requested it, not because the authorities on their own would carry the process, as Colombia claimed was the normal way to operate. And on top of that, when the audit decided that the customs value was below indicative prices, the procedure that was applied in order to repay the importer was the procedure in Colombian legislation called reimbursement of excess taxes paid. Taxes paid. So it was a payment, it was not a deposit. It was the payment of custom duties. Nevertheless, I again say that, if I were the Colombian defendant, there was no better strategy, because this was a smart strategy, but still didn't work, because there were so many contradictions in the Colombian legislation. Also, the period for repayment took about 2 years. The Colombians were saying that this was a normal procedure, and all entries were audited and a decision made, and if a reimbursement was decided, there was no problem in reimbursement. But they found that typically reimbursement would take 2 years. So the panel found that no, this is not a guarantee, this is properly custom duties. You are determining an initial customs value that you can review later, but at the entry, before release of the goods, you are determining customs value proper. So this means that customs valuation rules apply. If it were a guarantee, customs valuation rules would not apply, because you are deciding not custom duties but the warranty. But because you are determining proper customs duties, customs valuation rules apply. And when you check this system of indicative prices with customs valuation rules, it's obvious that this is in breach of the WTO agreement, because the indicative prices are not transaction value. You have not determined why transaction value should not apply. You have provided no grounds case by case to deny transaction value. The indicative prices are not transaction value of identical goods, of similar goods, deductive value, computed value. They are not even the fallback method, because even in the fallback method, they found that indicative prices were in breach of two negative criteria. First, the indicative price is a method that systematically opts for the higher of two values. If your transaction value was above the indicative price, they would take transaction value. If your transaction value is below the indicative price, then you go with the indicative price. So you are always opting for the higher of two values, your transaction value or the indicative value, whichever is higher. And this is in breach of the criteria that transaction value, in the context of the fallback method, when all the methods fail, should not opt for the higher of two possible values. And also it was in breach of another negative criteria in the fallback method. Customs value should not be based on minimum values. And indicative prices are very obviously indicative price, minimum values. So the panel found that Colombia's rules of indicative prices were in breach of Colombia's obligations in the WTO valuation code. And there is also a point in this case, it's not the topic today, but I think it's worth raising the issue, that take into account that when we discuss customs value, this is going to have an impact on value-added tax, because the tax base at imports is customs value plus some adjustments. And if you impact on customs valuation, you impact on value-added tax. And the issue that Panama also raised was you are imposing an artificially high customs value, which translates into an artificially high value-added tax at imports tax base, which means you are discriminating against imports compared to domestic sales. In domestic sales, you accept the price. You don't check the price against an indicative price. But for imports, you check the value declared against the indicative price. And if the indicative price is higher, you take the indicative price. This is a discrimination which is against Article 3 of the GATT, national treatment. You cannot discriminate imports in internal taxes. In general, you cannot discriminate in internal legislation. And this is a very obvious discrimination against imports, indicative prices. But here the panel found that, okay, the problem is not in VAT legislation itself. The problem is in the fact that VAT refers to customs valuation. If we erase the problem in customs valuation, the problem in VAT disappears. So the panel decided, because we already have decided that customs valuation rules in Colombia are wrong, if they address customs valuation rules, the problem in VAT automatically disappears. So they decided not to rule against VAT legislation of Colombia, because the problem was totally in the field of customs valuation. Only that it had an impact on VAT. So this is worth thinking, that we are discussing here undervaluation for custom duties, but valuation for customs has an impact on value-added tax. And that has an impact on national treatment in the GATT. If we play with the rules in a way which is not totally in conformity with WTO, we are not only breaching the WTO customs valuation agreement, we are also in breach of national treatment. Okay, the other case is the Thailand cigarettes. This is an extremely complex case. I am not going to cover it full. I am only going to refer to issues that I think are relevant for discussion on undervaluation. They also covered issues regarding the deductive value method, because Thailand applied the deductive value method with many peculiarities that made it in breach also of the WTO obligations. Okay, the thing was, in Thailand, they have a national manufacturer of tobacco, and apparently Philippines discovered that members of the board of the Thai tobacco company, members of the board, sitting members, were high officers of customs and were also high officers of the Ministry of Finance. They had two salaries. They had a salary from the tobacco company, and they had a salary at the ministry or at customs. And because they had salaries from the national tobacco company, they initiated a campaign against imported tobacco. And the importer of tobacco was Philip Morris. Philip Morris Thailand was importing tobacco from the Philippines. And they find that suddenly they start reviewing all the import declaration of Philip Morris. And strange things happen to import declarations of tobacco Philip Morris. So in this case, this was not a problem of legislation, because they never put these rules into a written provision. It was an administrative practice. It was much more opaque. It was much more difficult to identify. But it was nevertheless systematic. It happened systematically to the Philip Morris imports and the imports of tobacco. Another issue in Thailand was that there were huge delays in appeals, administrative appeals, because in Thai legislation there is not a time limit to decide an administrative appeal. At the time of the report, the claimant, Philippines, provided evidence that they had cases pending for 7 years which had not been decided, pending for 7 years. I was in Thailand in 2012, and before the training for the Thai authorities, we were discussing with the delegates of the European Commission in Thailand, and they told me, here it's so full, because here the rules do not apply, because Thai customs is very corrupt, and on top of that, there is no time limit for appeals. So it can take forever. They can stop you for 10 years, 15 years, and not decide the issue. So you agree with customs or you are lost, because you could be on an appeal, pending an appeal for decades. Okay, the issue at discussion was that Thailand was rejecting transaction value, and instead of transaction value, they were applying a variant, a peculiar deductive value method. The grounds that Thai authorities provided for denying transaction value was that the transactions were between related parties. The transactions were between related parties, and therefore the price was unacceptable. I mean, no justification whatsoever why the price is unacceptable, because it is not enough that the parties are related. The relationship has had an influence on the price. No, they did not discuss that. Simply because you are related, your price has to be rejected, and transaction value cannot apply. Okay, and so the discussion is this enough grounds? Is this enough grounds to reject transaction value? Can customs deny transaction value only because the parties are related and therefore the price has to be rejected? And this is a very interesting discussion by the panel in the report. You know that in order between related parties to reject transaction value, there is the general exam and the test values. Yeah? The general exam is made by the customs authorities, and in the general exam, the panel focuses on the word exam. What does exam mean? And they find that exam is a word that includes carefully considering, investigating, inquiring into. You have to work to examine. Examination is an active task, not a passive task. It's something that you need to involve into. And you, in order to examine, you request information, obviously, from the trader, but not only from the trader. You have other sources, you have other tools, and you engage into examination. The importers have the responsibility to provide information. But the reason why importers need to provide information is because that information is going to be examined by the authorities. So this takes us to the issue of the burden of proof. Who has the burden of proof? And I think in customs valuation, the burden of proof is a bit confusing because we tend to think the burden of proof is with the importer. I don't agree. The importers have to provide the documents, and a diligent importer should have certain elements of evidence. An importer should have an invoice. An importer should have accounting records. An importer, if they want, I mean, they have access to, they can provide bank information. This is the transfer we made. This is what you can expect from traders. Traders should provide this information. But then it is for customs to elaborate on that information. If you receive that information, you work on that, you carefully consider, investigate, and inquire based on that information, and you read your own analysis. But this is a task for customs. So, in my view, the burden of proof is for customs. Only that, in order to meet that burden of proof, customs can resort to using their powers to request evidence from importers. You must submit the invoice, you must submit the accounting records, you must submit the certificate or the justification for payment. But with those documents, the investigation belongs to customs. And it is the task of customs to reach a conclusion. And Jorge said, provide the grounds, motivate why you depart from transaction value. Motivate means you have motives. It's very obvious. In order to depart from transaction value, you have to motivate, which means you need to have motives. And the technical committee said the fact that a price is small, is a low price, is not grounds enough to reject transaction value. So the motive cannot only be the price is low. Jorge said an example where the seller, the exporter, was selling at a loss. The price did not cover cost, but there were commercial reasons for that. There were commercial reasons because the trader wanted to take market share. And in order to take market share, traders do that. They could assume losses initially. So in the market, they are better known and they are appreciated. And with that, they get business. The competent authorities have an independent duty of investigation. Not only sitting at the table asking for more and more documents. An independent from the importer duty of investigation. And they cannot remain passive in the face of possible shortcomings in the evidence submitted and views expressed by the interested parties. An active role of customs must actively seek pertinent information, degree of activity, not passive customs. Customs that engage into finding out the facts. And then they must communicate to the trader, to the declarant. The communication to the trader is a formal guarantee, which is also relevant because the panel observes this motivation needs to allow the courts and the panels to decide if customs perform their duties properly. So motivation has a role which goes beyond a formal requirement. It is a substantive requirement because otherwise there is no way to control if customs perform their duties properly. Okay, again, I don't know in which slide. It's not in this slide. In one of the slides, the panel also observes that customs valuation is made on a case-by-case basis. On a case-by-case basis. You can, I think it's regarding Colombia, the Colombia case. Customs valuation is made on a case-by-case basis. You cannot use parameters. You cannot use a normal price. You cannot use market values. Those you can use as a risk assessment element to identify transactions at risk, but not to impose a customs value. Customs value must be determined transaction by transaction based on the circumstances of the case. And I think this is very important to make a distinction with the Brussels definition of value with market values. In market values, that would be allowed to have average values or reference prices or things like that, or databases. But with the customs valuation agreement, you cannot do that because customs valuation must be based on the merits of the specific transaction. We have the recent Lifosa case where the court accepted that the price could be negative. The seller was ready to accept a negative price. And in the customs valuation code, that is acceptable. So the panel found that Thai customs had failed to examine the circumstances of the sale and was inconsistent with Article 1. So this discussion in Thailand, in the Thailand case, was regarding the general exam to reject transaction value between related parties. But in my opinion, this is also relevant to examine Article 140 of the Implementing Act and to examine more generally departure from transaction value. Departure from transaction value must be based on an examination. Okay, again, the explanation to give the details, as I said, because this is not only a formal requirement, but a material in order to be able to control that customs has performed their task adequately. In Article 16 of the Customs Valuation Code, declarants or importers have the opportunity to request, it has to be requested, a written explanation of the value of the goods. And the panel finds that in this written explanation of the value, customs must provide an explanation why transaction value was rejected. Not only transaction value, but all the hierarchically superior methods, if they were rejected, why they were rejected. So in the explanation of the value that was determined for the goods, customs, if they reject a method, they need to explain the reasons why they reject the method. And again, they found that Thai customs did not provide an explanation because the only explanation they provided was, you are related parties and therefore your prices are not acceptable. And that would be all. I am open for questions. Thank you for your attention.